Welcome to the CFO Track podcast. I'm your host, Tom Hunter, and every week I'll be bringing you stories from some of Australia's best and brightest CFOs and the lessons they learnt along the way. My goal for the podcast is to provide learning and development opportunities for those wanting to get to the level of the guests on this show, but they just didn't have the access to those lessons otherwise. Let's get into it. Today, in a slightly different episode, I'm joined by Dr. Tanvir Uddin, the CEO and founder of Wholesome, an ethical investment fund that supports underserved and impactful entrepreneurs. Tanvir shares an unconventional journey into finance from consulting through to building his own fund from the ground up, and shares some brilliant insight around capital efficiencies and why understanding your cash flow from day one makes or breaks a startup. I hope you enjoy it, so here we go. This episode is brought to you by Tallystone.com, the all-in-one data room, capital register and board workflow in one continuous system of record. Check out the detail mid-episode. Tanvir Uddin, welcome to the CFO Track podcast.
Thanks, Tom. Thanks for having me.
No worries. How's the week been? How's things?
Good. I'm in between launching a new retail fund product and studying for my director's course. So yeah, lots happening.
Okay. Nice. That sounds full on. Where do you find the time?
Well, I try as much as I can, as one reasonably could. But it requires a lot of flexibility. I've got a little son who's 22 and a half, so yeah, juggling that. But yeah, it definitely keeps me on my toes. But yeah, you gotta make any spare moment to do the things that are important.
Yeah, well, it's just the way it goes, right? It's hard to avoid. You just get as much done as you can, and the rest just waits, I guess.
That's it.
Nice. Well, I've already given the listeners a bit of an intro to yourself, but I can never do it justice. So it'd be good to hear from you a bit more about yourself and the business.
Yeah, sure. So I'm the founder and CEO of Invest Wholesome. We're an ethical and impact-focused investment and finance company. We've currently got an investment fund that supports small, medium businesses. Both we invest in emerging markets globally, but also in countries like in Australia, where we have a big focus. We invest into underserved and migrant entrepreneurs. And on the other side, we're providing a sort of competitive fixed income return, typically targeting 8 to 10%. Obviously, performance never guaranteed, but we've basically tried to solve these sort of two problems on these side: people wanting more quality fixed income, and businesses that want funding on the other side.
Yeah, right. And so you've taken a slightly different route to other guests, which I really like. So what was it specifically about finance early days that drew you to the industry?
Yeah, look, to be honest, I remember being sort of a first year arts law student, looking at my friends sort of struggling with their accounting 101 and thinking, gosh, I don't need to do that. And that'd be probably a bit too smug. But I think fundamentally, finance gets a bit of a bad rap everywhere, and whether as a student or in society, I think financiers are one of the least trusted, or bankers are in any case. But the fundamental thing that drew me into finance was the realization that if I want to have impact at scale, and I really want to move capital where it can. And obviously, there's no doubt capital is the most powerful force in moving and changing societies and countries and economies. I needed to, learn about it beyond just sort of, jokes to my accounting friends, but to be able to play a role in that space, I needed to understand it and work at it from an operational level, not just the theoretical academic angle, which I had some exposure to in my master's, but how do we work with investors? How do we work with investees? So that was a realization. The pathway to get there was very unconventional, but it was just incrementally. So when I, from my earliest jobs, you've got to have some sort of commercial acumen and to deal with transactions or deal with other parties. And then increasingly, I found myself in sort of the investments sort of domain through startups and a bunch of other companies. And so that was the route there. And incrementally just realizing, okay, I got to learn more about this. So right now I'm learning about financial statements all over again, but from a governance angle, which is again a different angle to being sort of more in-house CFO, but all very important.
Yeah, right. So your first role post uni was Muslim Aid, right? That's a
Yes.
not for profit.
Yeah, that's right. Yeah. So I was
Yeah,
in a not-for-profit and managing a portfolio of a couple of $1 million. So yeah, first foray into kind of managing money in some regards,
yeah,
and not having the full understanding of that. But yeah, that was an interesting experience to realize that even nonprofits have to understand cash flow inflows and outflows.
yeah,
And the thing that frustrated me about, I mean, I thought I'd spend a career in nonprofits. I thought that that's what I would want to do, go find a really cool, exciting NGO. But what
yeah,
frustrated me about that, and also kind of to answer that question earlier about pivoting into finance, was the realization of sustainability, that the
yeah,
model, charity models typically rely on, we've got to keep collecting donations to run the programs. And I thought,
yeah.
gosh, that's such an inefficient way to do things. I mean, it's important when there's disasters and
Sure.
emergencies, we've got to raise
Yeah,
capital. But
yeah,
if I want to have impact at scale, this can maybe a part of it, but this cannot be the core of what I do.
yeah. Right.
Yeah.
And so you were there for a little while, and then was it anything in particular that I guess drove you to working at McKinsey afterwards, or is it just
Yeah.
uh, yeah? What was the transition there?
Well, so I'd already been frustrated with the NGO sort of sector. So I left Muslim Aid. I had like a couple more courses left in my law degree, so I was wrapping
Yeah.
that up. But I had an interesting experience meeting a bunch of management consultants, unusually in a non-for-profit context. So I was in Bangladesh, interning with an NGO called the Hunger Project,
Okay.
and the Hunger Project have a bunch of essentially donors, what they called social investors, who came on a trip from Australia. And among them
Yeah.
were management consultants from Nous, from Hayes Consulting, and there was a managing partner of McKinsey, Michael
Yeah.
Rennie. And so I got a bit of exposure to them and the way that they think about the world and what they do with their lives. A couple of years fast forward after I'd finished my law degree, I reached out to him to get some advice about consulting and what he thought about it. And he was like, yeah, you should definitely give it a go. And he put me through into the recruitment process. So that was the sort of transition. I never wanted to be a management consultant when I was sort of starting off at uni,
Yeah.
but I realized that it provided a good generalist skill set, particularly when I left, thinking, what do I do? I've got a law degree, I did an economics honors, and I've got my arts degree in development studies. So that was a good generalist start. But in hindsight, yeah, I couldn't have scripted it better in the sense that I was very fortunate
Yeah.
to learn so much about the business world and strategy, and just being around people who were just quite intelligent, and then they had a very
Mm,
structured way about how they thought about the world. And I thought that that's just a good mindset that
mm.
that I obviously didn't have a great experience with in sort of
Sure.
previously at Muslim Aid. Yeah.
So what sort of projects were you working on? Like what sort of work were you doing at McKinsey?
McKinsey was a mix of operational improvement and strategy. So
Okay.
we were serving a lot of mining clients at the time. So I worked with a number of miners, particularly coal and gold.
Okay.
And that was primarily operational improvement, whether it be capital scrubbing. So we were figuring out how to optimize long-term capital deployment plans. And
Hmm.
then with one of the other miners, they were going through a massive transformation, and that was really down to the nitty gritty of modeling out certain initiatives through to managing the implementation of that, with their various mine sites and the other stakeholders. And I was in the transformation office, which is a great insight into how these very big companies work. But it comes down to very simple fundamentals, really, about, okay, we want to chase this opportunity. What's the payback period? Does it make sense? What's the risks? What's the feasibility? So it was really good insight into that. So I was kind of thrown into the deep end of what a finance manager would kind of do as part of that team.
Yep.
And then the strategy stuff was really interesting. Again, looking at, okay, what do we want to do in the next 3 to 5 years? So whether it be in a telco context or retail context.
Mm.
So again, really good grounding and understanding in big sort of capital deployment decision
Yeah.
making, whilst obviously managing multiple stakeholders. Because at the end of the day, you can have a great strategy, and the numbers might make sense, but you've got to be able to build conviction in a team. So that's something I got a bit of a taste on, but
Yeah.
that development was going to have to come a lot later once I was
Yeah.
actually in the
Yeah.
real
For
world.
sure. And so, how important do you think that period was for you in terms of the
Mm.
rest of your career, building those processes and just understanding the structure of how things run at a
Yeah.
grand scale?
Look, one of the things I say to a lot of interns as well when I think about that period is there's probably a couple of fundamental skills that if you are able to build and do it repetitively, it just sets you apart. So there's probably
Mm,
three things I would say. Number one is
okay.
just basics of financial modeling. I mean, I didn't have a finance background, but in McKinsey, they mentor and teach you how to do the basics of financial modeling, and you're applying that throughout all your engagements. So just able basically to be able to fire up Excel to model out a scenario or to run some calculations, that's just a no-brainer. A lot of people struggle with that in corporate, I found. So having that skill set just really allows you to just go, okay, let me just quickly work out, does this make sense? And
Mm,
then to put a case together. Then that leads into
yep.
the second point, which is to be able to put together really good executive communications. Primarily at the time, we were doing a lot of PowerPoint. And in a lot of my workplaces after I left McKinsey, whether it be the Islamic Development Bank or whether it be at Bright, we still used a lot of PowerPoint. And so to be
Yeah.
able to use that relevant form of executive communication and to do it well, because you've got to present it to someone. They're not going to sit there and look at your Excel model. They're not going.
Yeah.
You can't point them to a report. They're going to say, "All right, give me the top-down comms on particularly this." Now, obviously, that information I'm sharing is probably dated nowadays with AI tools, and
Sure.
I wonder if I mean, we don't use PowerPoint in Wholesome these days, to
Yeah.
be
Okay.
honest.
All right. Yeah.
So we use tools like Notion or
Yeah.
just
Okay.
basically, put through things through an email if we need to make a decision.
Yeah.
So that might be a bit dated, but at the end of the day, it's about executive communication. And the third
Yeah.
thing was about storytelling and storylining. So how do you build, how do you get someone who might not know the full context to not only appreciate the context, but then to support the decision you want to make, and that's something that we just kept getting drilled into, because we would be working with operational managers all the way through to executive team, board members. So at the end of the day, as humans, we like stories, and we are
Yeah.
moved by stories a lot more than we're moved by numbers. If we look at some of the most impressive capital raises, like you look at SpaceX last week, that's
Yeah.
selling a story. The
Yeah.
fundamentals may be
Yeah.
questionable, but they've sold an amazing story, and investors have
Yeah.
bought that story, and they're going to go along on that ride. So that those are three things that I think we did a lot of. We got a lot of feedback on, a lot of coaching on, and not to say I've perfected them, but it did help me in other jobs down the track where others may not have had that same experience.
100%. I think that the storytelling piece is so spot on, and I don't think that'll ever go out of style
Mm.
because the more tech that comes in, the more AI, the more automation that you layer in, that storytelling piece is even more critical because not everyone can do it either. So if
Yeah,
you're able
yeah.
to bring that to the table,
Look,
massive, massive point of difference.
some AI experts say that is the fundamental skill moving forward, because everything
Yeah,
else can be replaced or someone else can do it more efficiently. But
sure.
to
Yeah,
tell an authentic story is what's going to set people apart.
nice, nice. And so you were at McKinsey for quite a couple of years, and then you took a role with was it a farming org in Indonesia or something? Is that
Yeah,
right?
so President Clinton started a foundation when he left being a
Okay.
president in the US, and the foundation did a lot of work around the world. One of them was around poverty alleviation and
Okay.
partnerships. They started a fund that was essentially capitalized by Frank Giustra, who's the billionaire owner of Universal Studios,
Yeah.
and
Right.
and so it was I think initially $100 million fund. They were going to do some work in Haiti post the earthquake there.
Yeah.
And what they then realized was, instead of giving grants and trying to do short-term sort of, poverty alleviation type projects, what if they thought about thought about the whole supply chain, that and targeting specific supply chains that can have a huge impact. And they landed upon agriculture, and particularly agriculture supply chains. And so developed a model where they would create social enterprises that would buy goods from farmers after they've trained them, provide working capital, and then sell them to an off-taker. So
Okay.
my role was to help set up their Southeast Asia operations. So after McKinsey, I went there, flew to Indonesia, was part of sort of a team putting together the financial model, visiting a lot of farmers, and we're working on two particular commodities, coconut sugar and black soybeans, because that was going to be a core ingredient for a product that Unilever had a strong market share in, but they were struggling with
Mm.
supply. So it was a bit of a win-win situation. So we were modeling out, okay, if we provide working capital to farmers, if we help them with training, we aggregate their product, can we get a high level of quality and quantity to meet Unilever's demand? So that was sort of my, very first sort of finance manager type role, to kind of put that model together, get it approved from an investment committee, and then start to build it out. So
Yeah.
working on unit economics, like, okay, we're going to buy this many kilos at this price. It's going to
Yeah.
cost this much to transport. And is Unilever going to be happy with the price at the end? That was sort
Yeah.
of what we were figuring out.
And so you see, you've gone from one of the biggest consulting businesses in the world to like this region. Was it considered a non for profit at the time? Was it still a fund,
No, no,
or
it,
what
it
was?
is it is a non-profit operation.
Yeah,
I mean, they have certain commercial targets to maintain the
sure,
capital base, but yeah, they're not paying any dividends to any shareholders.
sure.
Mm.
Yeah, okay. So what was that transition like then, going from hyper structure and
Yeah,
process to
yeah,
something
yeah,
not
yeah.
quite the same?
Oh, look, very look. There was a lot of things that were jarring. I mean, look, it was very exciting, to be honest. Like, I was really excited to go and travel and live in
Yeah,
Indonesia and travel around. So that was really exciting. But yeah, look, number of things that are jarring. I mean, you're going from contexts where you're dealing with larger, I guess, amounts of capital, and there's a very strong commercial imperative. So
yeah,
typically, McKinsey's projects are endorsed by the board or by the C-suite, and it's just going to trickle down. So you're going to be able to get data when you want it. You're going to get
yeah,
the stakeholders in a room for a meeting to push things
yeah,
along, because
yeah,
also they're paying a lot of McKinsey fees,
yeah,
so
yeah,
they
yeah,
want to
yeah.
get outcomes. Now suddenly you're in a situation where you've got Unilever being a very large organization, very bureaucratic organization. You got the foundation, you got
Sure.
these farmer cooperatives, and you're trying to get them all to work together.
Yeah,
Definitely more challenging. But I think going back to storytelling, it's all about getting them all aligned on what they want. And when people are all aligned and they believe in the mission, it is a lot easier. But I remember things were very different. Like when I was dealing with the Unilever there was a counterpart team on their side, and I remember the level of due diligence that they were doing. And I was thinking to myself, this is like we're asking them for like $90,000 for the pilot. And like,
yeah,
they're going round and round and asking all these questions. I'm like, yeah, look, sure, we haven't figured everything out, but we're here to test a pilot. There's already funding committed from the foundation.
yeah.
And this guy was sitting there spending, like, I remember like in one afternoon in Jakarta on a weekend, the guy had flown in from Singapore and was like spending 5, 6 hours scrutinizing the financial model. And I was
Yeah,
thinking,
yeah.
gosh, like this is insane.
You probably
Because,
spent 5 grand on the flight.
exactly. And it's like, I mean, at McKinsey, we generally, like they say the 80/20 rule. Like you look
Yeah.
at, okay, well, what do I need to do to get something across the line? So that was one challenge. The other interesting challenge was cultural. Um, in Australia, and particularly in corporate Australia, there's a sort of, I guess, you want to work efficiently, but you also want to get things done. You communicate very firmly, and you expect
Mm.
people to be, to be transparent.
Yeah.
Indonesians are very dynamic. I love the Indonesian sort of economy. It's very vibrant, a lot of amazing startups, but culturally it's very different. They work on the basis of a lot of collegiality, a lot of being non-confrontational. So it was
Okay.
really interesting to kind of learn, okay, how do we work where people don't want to necessarily communicate negative news or bad news, particularly when you're dealing with people across the different islands. So
Yeah.
that was
Okay.
a new learning curve. And it's relevant in going from consulting to corporate, because in corporate you'll have different personalities and organizations of different cultures. They're not paying McKinsey fees, so they're not going to necessarily deliver everything that you want in the particular
Sure.
time. So that was a big learning curve around how to work with different stakeholders, different cultural practices,
Mm.
but at the same time trying to apply a certain rigor around, okay, here's the decision, these are the financial drivers of the decision, and here's how we're
Hmm.
going to implement and how we're going to monitor it. So I mean, to be honest, that was probably very relevant to starting a business, because right now I'm dependent on so many stakeholders, and they're not all going to be responding to my messages, or they're
Yeah.
not going to meet
Yeah.
me at the same level or give me the same priority. So I've still got to make things work. So it's not about, what's better or worse. It's about learning how to adapt to those conditions, and I think that was a great experience for that.
I know that to close a capital round, everything has to be spot on. But we've had our moments where we've had to scramble. The cap table is in a spreadsheet that might be right, the board resolutions are in a Dropbox that nobody's paying for, and an email thread from 2022. And the data room, that was built on a Sunday night because the investor asked for it by Monday. We know better and we know how risky it is. Tallystone puts all this in one place. AI-powered data rooms, capital register, board and shareholder workflows. One system that's always current, not just when an investor asks. I use it for story recruitment and it works like a dream to get set up. So make your job easier and de-risk the DD. It's the infrastructure that your corporate record should have had from day one. Start a free 30-day trial and get a live data room set up in 10 minutes. Use the promo code CFOTrack and find out more at tallystone.com. Let's get back to the show.
Yeah, nice. And then, so when did the Saudi role come up? That was around that time.
Yeah. So I'd spent about a year sort of in a finance manager role. I've been working on investment sort of theses. I was also setting up the first financial systems for that enterprise in Indonesia. So I was literally on zero and, creating helping with the bookkeeping and collecting all that. So I remember doing that and thinking, like, this is good. Like I'm learning a lot, but I need to, I feel like I'm out of my depth, to be honest.
Sure,
And if I really want to have more success being able to run financial functions and to work in investments, which was a big part of it, I realized that there is a lot more technical knowledge I need to learn. Now, I had a relative who worked at the Islamic Development Bank, and he worked in their private sector arm, which was doing investments directly into corporates, and as well as large sort of project finance deals like infrastructure and so forth. And he said that there's a fellowship here if you want to apply. So the previous year I missed the cutoff, and then the next year I applied and I got in. And I thought, and the reason I wanted to get in was not only learning investment banking and sort of corporate finance, but they were going to sponsor us to do a Masters of Finance, which had a core conventional finance component and an Islamic finance component. And I thought, okay, they're going to sponsor me to learn. It was a top university in Europe that they were partnered with called the IE Business School, one of the leading universities in Europe. And I thought, great, they'll pay for that. I'll get to learn. This is my ticket to the next level of professional development that I needed. So it was all going to be. So I said, yeah, let's do it. Obviously, never been to Saudi Arabia before. Had no idea about working in a sort of an investment company. So all those trepidations were there, but I was excited about kind of the learning experience. And so that's what took me out to Saudi.
How was it?
Overall, it was really good from the learning perspective. So I really got what I was hoping for, because we had 2 secondments in that sort of fellowship program. My first one was in their investment banking team, particularly working on infrastructure project finance. So like everything from feasibility studies, financial modeling, through to the whole legal process, which is another thing, because you have financial covenants and you got to negotiate that. And then you get things funded, and then it goes into a monitoring phase. So I learned a lot about that. The second secondment was very relevant to my current role in Wholesome, because it was in asset management. So I was in their funds team, and they had a couple of income funds that were using to manage their treasury function. So I got to learn a lot about that. So the learning was great, and both secondments were very on point for me. The thing that was challenging was that it was just a very large bureaucratic organization. I mean, McKinsey was a large organization, but we worked in small teams, and everything was really sort of a flat structure relatively. But culturally speaking, large international development banks, and it's the same across World Bank, ADB, they all have very similar sort of profiles. Things are fairly rigid, and I was a little bit frustrated by that. Like I always wanted to come with new ideas. Let's start a new fund. Let's do this. So that everyone's a bit like, stay in your lane. Just do what you're being asked to do. And I was seen as a bit of the guy from Australia is like trying to rock the boat a bit too much. But I was like, look, I'm here to. Look, the development banks, all these development banks are there to make the world better. And I felt like everyone was in very comfortable, cushy finance jobs, getting paid international salaries with education, healthcare, all that. And I felt like the culture just wasn't fitting my sort of profile. So that was a bit of a frustration, and that's kind of what led me to kind of finish up a bit earlier. But at the same time, I did start to have, because I was exploring the region, things were buzzing. The startup scene was definitely starting to pop up.
Yeah.
And
Okay.
I was attending sort of startup gatherings and events out in sort of and meeting founders in like Dubai and Istanbul, and I've been to London a few times as well. So
Yeah.
my focus was starting to shift. I said, okay, look, I've kind of learned as much as I really need to. I don't think I want to continue going deep into a finance or an investment company where it's going to be like this very bureaucratic, very large. I want to kind of work where it's a bit more innovative and cutting edge. And so I was really starting to look at what are opportunities in the startup space. And I had a couple of interviews as well while I was in the region.
Yeah.
But I was starting to formulate sort of my next plan. So yeah, so that's why I thought, okay, I don't want to work in large organizations anymore.
Yeah.
And it was also, I was getting a bit homesick. I wanted to come back. I've been away for about
Yeah.
maybe 3 years
Nice.
or so.
Okay.
And so, yeah, end of 2017, I moved back to Australia
Yeah.
and
Cool.
trying to look at the next thing there.
Yeah. Nice. And so you lined up a role with Bright. So that would have been a fairly not similar transition, but
Mm.
like there was a lot of translatable experience you would have been able to bring to that role.
Yeah, well, so at first it seemed a little bit ambiguous because the role was for a commercial manager, and the job description described someone who was like had a CA or had worked in a big tier investment bank, and I thought,
Yeah.
okay, well, I've got a couple of these skills that could be relevant, but I didn't know how much was going to be sort of finance versus operations
Mhm.
because the hiring manager was this chief operating officer who also managed their credit function. But the thing I liked
Yeah.
about that was that I would get exposure to many different parts of a startup that was essentially they had cross Series B raise, and they were
Okay.
looking to scale to their Series C. So
Yeah. Right.
I thought,
How many headcount were they? It was a little
it
while
was
ago
still
now.
fairly early. I was about
Yeah.
34.
Okay. All right.
Yeah,
Cool.
so
Yeah.
very early. They had just completed, I think, about an $18 million raise, and that was meant to help them sort of go through an aggressive growth period. And so I was part of that
Okay.
sort of hiring
Yep.
phase. But the COO was ex-Macquarie Bank director John Roll, and I thought, okay, great. So guy who's been there, done that, I can learn a ton from him. He manages a number of key functions, so I can kind of get exposure across the business. And so yeah, I was very excited and very grateful for that opportunity. And yeah, over the course of my time at Bright, I learned a ton,
Mm.
and it really kind of solidified things I'd been learning before. So I mean, all the same things that we've talked about before. So financial modeling, putting executive communications together, strategy packs, but it was also very operational in the sense that okay, we need to understand our credit risk exposure and modify our credit policy and then submit that to our funders. So
Yep.
that's like pulling out all the data that's available, understanding, what's causing bad debts to maybe go up, or where are our policies actually working really well,
Mm.
and then the implementation part, which I was kind of building up at the Clinton Foundation job, because I had to work now with stakeholders in the risk team and the operations team, and that was interesting but having done that in a previous context really helped me appreciate that again the culture differences.
Yeah.
I remember my manager used to explain that like investment bankers and management consultants, they tend to think about the world and approach it in a certain way. But when you're in organizations and you're working with people across many different departments, it's not necessarily the same. So you've got to go
Sure.
through an adjustment. And like,
Yeah.
a lot of consultant friends that I worked with transition into corporate or industry, they talk about that transition because you've got to think about, okay, how do I communicate more effectively? How do I inspire and motivate people who aren't just
Mm.
driven by, say, big stakeholder pushes or big sort of financial incentives, but still to get outcomes for the organization. So that was a really good learning about operationalizing what we came up that department with John was called corporate development.
Okay.
Um, but it was good. It was a high performing team. I was surrounded by other ex sort of consultants and finance folks, and basically learnt about startups. Like, how do you actually
Yeah.
go, not so much from 0 to 1, but like from 1 to 10? Like, what's that look
Yeah.
like? So I wanted to deepen my startup experience, and in the idea that with the hope and ambition that one day I could have my own company. So
Yeah.
I actually highly recommend people who want to who want to do their own startup or want to be part of an early stage startup is to go and learn working in another startup, because it'll become pattern recognition. You don't have to keep
Yeah.
figuring it out, or at the very least from a a cultural perspective, you'll be comfortable with ambiguity, with agility, and not necessarily having clear pathways that would be the case in a standard corporate job.
So on that, but the 1 to 10 that you were saying before, like what was it that was unexpected that you did learn from it that
Yeah.
coming in was, oh yeah, you didn't realize?
Well, I remember, I mean, there's many examples, but one example would be, I remember when some new competitors came into the market and they were taking share from us. And
Yeah,
that was like, if this continues, like we could potentially be wiped out.
sure.
And that's like, okay, you don't necessarily think, oh yeah, in 6 months a competitor's going to come and take me out. But in hindsight, you should always prepare for that, right? Like, but going through the experience, I remember it was a little bit confronting, and we suddenly had to clear our calendars for the next 2 or 3 weeks when we were seeing this to do a diagnosis of what was going on, then work very rapidly with the operations and product team to roll out some new feature changes and new sales incentives with our sales team. And I remember we were developing a sales dashboard, and I was my job was to kind of develop that dashboard, but then use it to start figuring out new pricing options that the sales team could go and negotiate. So that was like just that rapid fire situation where you're a bit confronted by the situation, but then going back to fundamentals, figuring out what's going on, and then working really, really well with the team. And obviously that situation was good for getting a lot of things through the door, because you wouldn't get as much opposition from the operations team or the tech team, because the CEO said, we need to fix this. So that was good to kind of see that. But yeah, like, I mean, those sort of things you just don't appreciate from the outset. I mean, because think about it, most of the stories that you hear about startups in the news and media is often showing all the great things they've done. They've raised an X $1 million Series A, or they've signed a new partnership. But until you're in the sort of fire pit, you don't really appreciate what happens behind the scenes. And I think that any founder, anyone who wants to start a business, so it doesn't matter, even if it's not a business, you want to start some initiative, you've got to have a healthy appreciation of risk, of things not going to plan. And I saw that all the way through. And even we were trying to launch new products, getting rejected by funders.
Yeah.
Just seeing no from external parties. That was just a great learning. And I guess it helped me appreciate that, it's not a linear path.
Yeah.
And then just to have a bit of patience and a bit of, I guess, kindness to yourself and others, that, if it was that easy, everyone else would just do it and they'll just replicate it.
Exactly right.
And I think that perseverance, and I saw that a lot in the CEO, like Catherine McConnell, an incredible founder. She's won a ton of awards. It's not just that she's a hustler, it's that she perseveres through these adverse situations. And I think we saw that from the top down. And before I became a CEO of my own company, I appreciated that you've got to have, hold your nerves, and just keep to the mission.
I think what you just said is so spot on. Like, everyone sees the cap raises or the 1.6 billion eucalyptus exit. Oh yeah, let's get into startups, but it's full on. Like, early stage is just relentless. So I think a lot of people realize that until they actually get into it and experience it themselves.
Yeah, and one thing I say a lot about to emerging founders is from a very sort of finance view, which is you've got to understand your cash flow. And I think having had exposure to finance roles before, whether it be the Clinton Foundation managing like a small $200,000 budget, or working in investments, it made me appreciate, or actually even going further back to McKinsey, where we had that capital efficiency mindset. Startups sometimes can blow their budgets. I have a friend who started an investment service almost around the time as me, maybe a little bit earlier, but he's just blown through. He's blown through, unfortunately, quite a lot of his safe round capital raise, because he went on an aggressive growth trajectory, which again, not questioning his judgment, because he really felt that he had certain partnerships that were going to pay off. And I mean, that's part of risk taking. It's not about that, but when I started Wholesome, one of the things I reflected on at Bright and the startup after Viro was around, how do I get to product market fit as quickly as possible with the least amount of capital? And so that mindset has helped me preserve cash in Wholesome in a different way. So we haven't gone for an aggressive growth initially, because my insight was, I need my core product to show traction and track record, particularly being a fund product, before I can go for the growth, because the growth will come when people say, oh, you've got 2-3 years of track record. Great. You've got all these testimonials. Great. You've got great governance systems. Great. So that was something that I developed a bit more of a conservative approach to my startups, having seen where capital expenditures can go wrong. And you know, you hear all the disaster stories, or this startup's shutting down, or this one's in liquidation, and you think, gosh, is there another way we could do it? Again, it isn't easy to say, and in hindsight, everything seems crystal clear. But so without sort of making judgments on other startups, when I was building my own startup, I wanted to think about, I want to have a very firm handle on a couple of things. What's my unit economics? What's my cost of acquisition? How much runway do I have? And I look at my runway like every couple of weeks, if not every week, because I'm constantly recalculating, to thinking, what's the take in this month? What's the take out? And how do I go? So that mindset, a finance mindset, I think a lot of founders sometimes don't have, because they're technical people or they're marketing people. So if they don't have a finance person in their team, they should definitely learn. And as hopefully I've demonstrated, you don't need to have done accounting 101 and been a finance major in undergrad. You can learn it through your work experience. But nonetheless, very important for organizations. And I'm studying this right now in my governance course, because, you know, ASIC will not tolerate any director who lets a company run insolvent.
No, definitely not.
Quick one before we get back to it. If you're listening to this podcast, you probably already know that I recruit for senior finance professionals for high growth businesses. That's what I do outside of this show. My approach is built around storytelling. When I take on a search, I build a narrative around the business, who they are, what they're building, where they're going, and why that role matters. Before I reach out to a single candidate, I tell that story across multiple channels to my network of over 28,000 finance professionals in Australia, so that when I do start conversations, candidates already know who you are and there's a level of buy-in before I even contact them. So if you're a founder, CEO, or CFO that's thinking about a finance hire, even if it's early days, I'm always happy to chat. Whether that's a question, some free advice, or a sense check on what the market looks like. You can find me on LinkedIn or at storyrecruitment.com.au. All right, let's get back into it.
What led up then to the point where you did found Viro?
So I was at Bright for 2.5 years. We just finished a massive Series C raise, and I was involved in the first asset-backed securitization, which was 100% green, because we had our green loans. So it was a bit of a high. I thought at that point it'd be good for me to take a sabbatical to finish my PhD, because I had started a PhD in microfinance back in 2013 when I graduated from undergrad, but McKinsey and Saudi and all that had slowed down that progress. But I thought, okay, I need to get it done. So I 2021 January, I finished up at Bright. I started on that research year. But towards the end of the year, I got a little bit restless. I was like, oh gosh, I want to get jump back into the startup arena. I want to look at new ideas. I want to kind of, explore things. I still had the job at Bright, but essentially a colleague who had been at Bright with me had gone through the Antler cohort in that year, and he connected me to a group of two founders who were working in who were trying to make electric vehicles more affordable and more accessible, and they wanted a finance person to help them with raising funding for their debt product. So I had done that at Bright, not in car finance, but in sort of solar and battery finance. And I thought, okay, great. This is a great segue for me to join a very early team, literally from 0 to 1. And I could learn. I've learned from that 1 to 10, but now I want to learn how do you actually get the first product, the first sale through the door. And so I said, yeah, look, I'm happy to help out. I want to work on a part-time basis initially because I'm trying to finish my PhD. They were happy with that. And so that led me to Viro. A couple of weeks in, one of their co-founders, due to some health reasons, decided to pull out, and they needed to sort of set up the team again and go through the investment committee with Antler. So I and Tessa, who was the chief marketing officer, we were brought on as to be co-founders essentially, because it's still very early stage and we need to get this through the investment committee. So it was my first founding opportunity. And first venture capital funding through Antler. So that was what led to that. So a little bit of an opportunity coming through. But it was just, I guess, fortunate that the experience at Bright was very relevant to this.
Yeah, nice. And then as CFO at the time.
Yes, that's right. So I had, I was responsible for, again, building the finance function from the ground up, raising capital. So capital raises, further equity raises, but also debt raises. So we were trying to, get funders on board. We did the first partnership with Plenty, which was really exciting. They had a buy now, pay later product, and they were happy to allow us to go under their credit license as a referrer. And we launched Australia's first buy now pay later electric vehicle product. So
cool.
It was very exciting to launch the first of its kind in that format, and to integrate it with all the other cool tech features that the CEO Will was building. It was short-lived because interest rates rose rapidly in 2022, and it killed that model. But it was good learning and good fun.
Yeah, nice. And then so that just prompted you to pull the trigger and do your own thing.
Well, yeah. So it was another year of that. So I then essentially we stopped doing our own finance sort of solution. We were going down the path actually creating a warehouse. I actually got a term sheet from a business funding income fund, but we had to can on that. But yeah, I was essentially then more in the operations. We were essentially selling electric vehicles through a package solution with funding and financing and insurance all packaged together, like a seamless checkout. And then the business moved towards a SaaS product where we're trying to help OEMs, so the manufacturers of vehicles and car distributors and dealers provide an online checkout experience. So at that point, I was sort of, I guess, my finance role or my finance sort of contribution was a lot limited, more just running the typical bookkeeping, BAS reports, all that stuff. And so Wholesome had been bubbling in the background for a couple of years, even prior to Viro. But yeah, when I saw that with Viro, I can't really add a lot more value at this point. And the company's going in a good direction, which I was very supportive of in terms of providing a SaaS product. And I thought, okay, maybe it's the time now that I jump, because I mean, one of the things you're always trying to figure out, and it's not the first time I was thinking about starting my own business, but the question is, when do I jump? When do I start? When do I, it could be, when do I experiment with a demo and a product, all the way through to a very big financial and very life-changing decision, which is I'm going to quit a comfortable job and I'm going to jump into sort of the unknown. So that question had been playing in my mind for a few years, but I thought at that point, I've worked in startups at very early stage, a bit more mature stage. I've gotten quite a lot of experience in financial services, and I know my next product would be in the financial technology space. So I thought, okay, now's maybe a time to go and do this properly. So wife was very supportive, family was supportive.
Good.
Although very still very nervous, and you carry that burden, of course, being someone as part of a broader family network. But I said, okay, look, I've got a couple of angel investors who have been following my journey for a few years.
Yeah, cool.
Some of them had tried a trial fund product that I did for a small group of investors, including my own money and a couple of friends. And we said, okay, let's just experiment. Prior to that, I was testing some strategy with my own money. So I was building up some bit of track record and some evidence of what we can do. But ultimately, the angel investors were like, look, we want to support you. And they knew what I was trying to do, and they knew that I'd been working in the space for a while. So very grateful for those angel investors. So 17 of them came on board with small checks ranging from 10 to, I think my largest investor was 60,000. But yeah, that essentially allowed me to go and start. And the bulk of that capital wasn't, I knew it wasn't going to be paying my wages. It was mainly because financial services is very regulated and there's a lot of costs. So
Yeah.
we knew that we were going to blow through maybe 200,000 just in terms of legals and compliance. So that was, once I had that in place, the funding, and I kind of knew the product and I had an idea of the product I wanted to build, that's when I kind of said, yep, now's the time. So yeah, July, we're heading up to July, almost 3 years now. But yeah, July 2023 was
Nice.
when I started. Yeah.
Yeah, good. So what was day one, week one like? What was you working through?
Well, at first it was a little bit, I don't know what the word is, but it was a bit disorienting because I suddenly didn't have structure. I didn't have a team. I was the only person in the team, and I was my first job was to kind of figure out how do we launch an investment product.
Yep.
And at that point, I realized, oh gosh, actually, there's a lot more that I don't know. Maybe I shouldn't have quit so early. Maybe I should have at least spent another couple of months getting a couple of quotes from service providers, going speaking to a few more people in the industry. I remember that was my first sort of feeling in the first couple of weeks. But beyond that, I started to go really deep into learning both about the product, about the industry, about the regulations, but also start thinking about customers. And I think the freedom you have when you're when you're fully dedicated on your business rather than being a side hustle or working on it on the side, is that you have the complete focus and distractionless ability to really think about what you're trying to do. And I think that without that, you can't connect those dots between opportunities, between how to launch your first product. You can't really do that, and you can't really experiment and just allow natural experimentation without kind of forcing results. Like, okay, I've got to really quickly survey 50 people and I need the results quickly. You can just have lots of casual conversations. So I did a lot of that and just a learning. So those first 6 months while it was setting up the fund was just a lot of learning, experimenting, and kind of figuring things out. And I think I'm really grateful for that because we avoided a number of major capital decisions that would have potentially put the longevity of Wholesome at risk. One of the key things was I initially thought I was going to start a retail fund.
Yeah. Okay.
And for those who don't know, Australian sort of Corporations Act sets up regulations differently for retail investors and wholesale investors. Wholesale funds that serve wholesale only. Obviously, there's a barrier to entry, so your market is a little bit smaller, but you can get up and running a lot quicker. Obviously, it means that wholesale investors are kind of signing away or at least recognizing that they don't have the same protections as a retail investor. I thought I was going to be a retail fund because a lot of my friends were retail. I was retail at the time. But I got some really great advice from some advisors and people who worked in the industry when I started looking at the numbers that they said, look, I know you're really gung-ho and you believe you can do this, but our advice would be start wholesale. I know it sounds hard because you probably don't know a lot of rich people and, they need to have more than $250,000 of pre-tax income over the last 2 years or $2.5 million of net assets. But it'll be better for you. And I'm so grateful I took that advice. It seemed, I remember thinking, but this is not my mission. I want to make investing, available to everyone. I want to democratize it. But that again came down to fundamentally, obviously respecting expertise, but it has to make sense in the financials. And I realized that it's going to take me a long time to raise the minimum capital to be a retail fund. And I'm just going to bleed out cash. And again, going back to what I said earlier, that I was really nervous about depleting capital because I don't know if I'm going to be able to raise again. There's no guarantees. Interest rates were going up. The startup industry from 2022 onwards, capital started drying up. Valuation started falling everywhere. So I didn't want to take that risk. And I'm really grateful that they gave me that advice. Because now we are about to launch a retail fund and we're in a much better financial position to do so.
Nice. So outside of the specific advice for your circumstances, from starting a business or a scale up or whatever as a whole, what do you think you learnt from that period that you would do differently going back or that you'd pass on to others? Yeah.
So it's fundamentally, I think, understanding the major capital decisions that you have to make. And if you're not confident on the execution against a very big capital investment, you've got to think about what other alternatives are there. And there were alternatives available. I just didn't know about them.
Okay.
And so the second piece of advice I would share is don't just take advice from one or two people. Go and speak to as many people as possible, because they will give you free knowledge.
Yeah.
I remember when I was doing my preparation for the fund, I spoke to maybe 5 or 6 law firms, different trustees. So whatever industry you're in, don't think that, oh, I've got enough. If you can go and speak to many people, not just the operators, the people who kind of make the supply value chain work. And again, I had a really good appreciation of value chain because that was my first finance job. Because we always think about the product side. I'm selling this product to this customer, but what does it take to make that product at the end point? And so if you don't speak to enough people, you won't appreciate risk, and particularly financial risk. And then it's just going back and adding it to your financial model. So I used to have these big tables where I'd break down all the costs and think about, okay, how about if this assumption went up or down? And so I think that basic homework needs to be done. And if you don't know how to do it, go and find a mentor or someone who can help you, because that could be so critical and devastating for your business if you don't understand that. The third thing I would say is distribution. I had not done much work in sales except for working at Telstra when I was at uni for a couple of months. And I hated selling on the floor. But sales is critical, but more important than the skill of sales is to think about your distribution. And I always tell people the story about Microsoft versus Slack. And you think about Slack, amazing product, Microsoft, greater distribution, has, it does a lot better. So people often think, I've got an amazing product. It's like, great, you can have the most amazing product, but if you can't get it into the hands of customers when they're ready to buy it, then there's no point. And so then I had to think really hard about distribution, and I didn't have budget for marketing. And so that led me down the path of doing a lot of events and in-person gatherings, which was generally free. And so that was a learning again, because if you're in the B2C space, you can't rely on someone else.
Yeah, nice. And so where's the business at the minute? You said the retail fund before, so how's everything all going otherwise?
Yeah, so we've just crossed over $9 million funds under management. We've got over 100. We've got about 120 wholesale investors in the fund. So we've broken even operationally, which is something I was really working towards in the last year. Actually, we've got a bit more on the operational break even. We're still bleeding some cash because we've got some staff costs and things like that. But now I've got enough of a confidence in the governance, the investment process. We've had more than 2 years of running this. So now all those retail investors have been interested in Wholesome, but also importantly, those who want to invest below the current minimum for the wholesale, which is $25,000, which could be a large amount of money for someone who wants to start out their investment career. So we're going to be basically launching the retail fund to allow people to get in with only as little as $1,000, and a shorter lock-in period, only 3 months compared to wholesale, which is 6 months. So I want to kind of launch the retail fund, expand the customer base, and then continue to grow the fund so we can do more impactful business investments.
Yeah, no, and with that, what do you see as the big challenges for this space over the next 2, 3, 5 years, whatever time period you want to put on?
So the number one thing, and look, everyone complains about it, but look, regulation is definitely more challenging, and it's getting more and more challenging over time, and particularly for retail investors. That's why a lot of the large funds don't have retail products anymore. They've exited that. And some of the trustees, who are the party that helps operate a fund, they also are moving out of their retail business because they're thinking the compliance is just not worth it. So that's probably the biggest challenge, and it requires us to go over and above what a normal wholesale fund would do from a disclosure perspective, from a transparency, from a governance, from just being more careful with investors' money. But that regulatory burden and risk creates opportunities. And I think that if someone, whatever industry one's in, if they really believe in what they want to do and they may want to make a difference in the world, they've got to kind of weather that. And the longer they can build solid systems and process to be able to do that, whatever industry they might be, that'll give their competitive edge. So that's why we're, again, taking it very cautiously. So I'm only releasing to 100 retail investors from the initial inception. We're going to kind of make sure that they're comfortable and settled before we then scale up further from there.
Yeah, gotcha.
So I think regulatory is a big one. The other one, of course, is I guess the talent is becoming challenging to kind of find and recruit. And for startups particularly, we're still waiting for, I guess, the clarity around what the recent budget changes will be.
Yeah.
And I feel, I mean, I'm not overly sort of pessimistic, but I've got to kind of understand the clarity around that in terms of how we can incentivize employees when we can't pay market salaries and we rely on ESOP or the employment sort of share options to recruit. So that's something that I'm constantly looking at. But it just requires us to be more creative in how we recruit staff, whether it be, creating more part-time roles or things like that. Yeah.
Well, if it stays as is, the CGT stuff, what do you think that'll do to the broader startup landscape in Australia?
Oh, look, I'm by no means an overall expert in that, but I think that what it would mean is that startups will have to be a bit more creative in terms of what the jobs and roles they create. And I think that, I mean, it's interesting because I've been on both sides of this issue. As an employee with ESOP and in startups, I've realized that very few people actually realize any material gain.
Yeah.
And in Australia, look, I hate to say this, but it's Australia just doesn't have the massive unicorn production of startups that would make people millionaires. I mean, look at SpaceX's story. Some people who are on like $80,000 salaries were now getting like $800,000 payouts. That doesn't just happen in Australia. So I think that the ESOP story needs to be sort of tweaked. So I'm on the one hand, I'm not too concerned about the CGT changes on ESOP because materially it doesn't really come out in the wash that much.
Sure.
But I think that what it requires when I talk about creative is I think that we've got to figure out how to make startups the most amazing place to work. And I've had an amazing experience. I had a great time at Bright. I really enjoyed the flexibilities that we as founders did in Viro. Like, for example, we wouldn't have compulsory take holidays in Christmas and Easter, or we would pay people fortnightly instead of monthly. So I think as a founder, I sit on the other side thinking, if I can't incentivize on ESOP as much, there's other things that I can do to create an amazing workplace. And I think that startups provide that. It's not always monetary. It's the lifestyle, it's the flexibility, it's the impact and mission. Yeah. So I think that's probably what startups are going to have to do, because I think Australia's got an amazing reputation globally. People want to come here. They love the lifestyle. How can we offer more to make it more attractive, even if we can't from an ESOP perspective?
Yeah, nice. Well, I think that's as good as a point as any to wrap up, but I really appreciate your time, Tanvir. I think your approach to impactful finance and building something of impact and making a difference is really cool. And I think a lot of listeners would agree. So if anyone's got any questions or wants to reach out about Wholesome and maybe even join the team, what's the best way to get a hold of you?
Oh, yeah, look, they can just follow me on LinkedIn. It's under my name there, and message me. That'd be the best way. Or they can just email us at hello@investwholesome.com from our website. Would love to hear from anyone. We love to speak to people and partner, and hopefully we can be of value.
Awesome. Well, yeah, thanks again for coming on the show.
No problem. Thanks, Tom. Appreciate your time.
Thanks for listening to the CFO Track. If you enjoyed the show, don't forget to like, subscribe, and share with a friend. I'll see you next time.